Hey, accounting scholars! Welcome back to Chapter 12, Section 2. Hey, for orientation purposes, we ended on cash inflows, but I wanted to take you back to the steps that we reviewed in the first video on this chapter to kind of get a stake in the ground in terms of where we are in the process. So the steps in the net present value method of capital budgeting basically is you're estimating where cash is going to come from and where cash is going to go. Then you determine the present value of those cash flows, and you take those net present values and you accept or reject the particular proposals. So we've talked about the sources of cash, which we identified as cash receipts from using the asset, use of working capital, which usually involves a decrease. There actually could be sale of assets. There could be tax savings associated with a particular investment, such as depreciation. So those would typically be inflows, which we talked about in section 1. Now, with any investment, there's going to be cash outflows. So let's talk about the outflow portion of the investment scenario. There could be increases in the working capital requirements, meaning that in order for this investment to occur, you have to increase working capital to make it happen. There also could be cash expenditures from using the asset. You in the coffee business, as we kind of talked about, on an ongoing basis, we would need to buy coffee cups, things of that nature to keep the business running. So those would typically be sources of cash outflows. Okay, so there is typically an initial investment that would need to be made in a investment project, and here again, the initial investment in the coffee business would involve the costs of the equipment and supplies to get the business going. So there would be the purchase price or costs of the assets involved. Primarily in the coffee business, that would be the coffee makers, the tables, and then the inventory associated with the supplies, such as the coffee itself. Then there would be costs incurred to receive the asset. And these could be shipping costs. If it was a large equipment purchase, these could be significant. I mean, you could imagine if you were investing in a factory and you had several large machines, there would be costs associated with just shipping the asset from the factory where it was made to your particular factory. Then there are costs associated with the setup of the asset. Here again, it wouldn't be so relevant in the coffee business, but if you could imagine yourself creating a factory, if there was large equipment involved, there would typically be installation costs of a piece of equipment or the asset. It's really all the costs necessary, if you were to put it in a nutshell, of the costs included in the initial investment. It's all the costs necessary to obtain and get the asset ready for its intended use. Okay, so what are some of the other factors that we need to think about? If you remember back to the net present value calculations that we did in the previous chapter, we always needed a particular interest rate as one of the variables that would be necessary to determine the net present value of a series of cash flows. And so one of the things we're going to be talking about in this particular chapter, which is a mouthful, it's weighted average cost of capital. Essentially what this means is if you look at how you're going to finance an investment from a business standpoint, there are really two choices. It could be debt that you get from a bank, such as a loan, which is going to have an interest rate associated with it, or it could come from company funds. It could come from retained earnings, or it could come from additional investments made by stockholders. But usually it's a combination of both, and therefore you need to take into account what the proportions are between debt finance and owner equity finance sources of capital. There's some particular equations that are associated with this. It sounds more complicated than it really is, but just keep in mind that what we're talking about when we talk about weighted average cost of capital, we're taking into consideration the relative proportions of the financing, how much comes from debt financing, how much comes from owner equity financing. So one of the questions is, okay, how is net present value determined? And here again, it's a mouthful, but it's really not that complicated. All you're really doing is taking the sum of the present value of the cash inflows and outflows minus the initial investment. Not really that complicated. It's again applying those same techniques that you learned in the prior chapter. Okay, so the question we might want to look at here, or the variable we want to introduce here, is how do we determine the net of tax amounts? Well, there's some specific steps here that you want to be aware of. First of all, you want to take the cash receipts and expenditures, and here again, it's a relatively simple mathematical equation. You take those cash flows times 1 minus the tax rate. We're going to have some examples of these later, so just make sure you get these particular formulas in your notes. Now we're going to talk about the second thing, which is the tax shield from depreciation. Depreciation, as you know, is a way to account for the use of an asset over time, but there really isn't necessarily a cash expenditure associated with that particular expense. And so therefore it is a tax shield. So the calculation here is you take the amount of depreciation that you're going to be allowed to use over time, and you multiply that by the tax rate. That takes into account or helps account for the net of tax amount. The third area is the proceeds from the sale of the assets. Here again, you would take the proceeds of the particular sale of an asset. You take that particular gain times the tax rate. And if there was a loss associated with the sale of an asset, then you would take the proceeds plus the loss times the tax rate. So here again, make sure that you get all of these in your notes, and we'll apply these in some problems in later sections of this particular chapter. But again, make sure you have these in your notes. Okay, we're going to end it here, guys, and we will be reviewing these notes from this particular section in class tomorrow, as well as taking a brief quiz. So have a great night, guys. We will see you tomorrow.